Well, there's been a lot of talk lately about silver having no choice but to explode higher. And honestly, I understand why people are saying it. The chart went from sleepy to unbelievable, then from unbelievable to painful, and now everybody is trying to figure out whether that move was the beginning of something much bigger or whether the easy money has already been made. So in this video, we're going to separate the real signal from the noise, and by the end, you're going to feel a lot calmer about what matters and what absolutely does not. And just to mark this properly, today is Sunday, May 3rd, New York date. Drop a comment below and tell me what day and date you're watching from, because I want to see how far this conversation travels. Also, if you value this kind of straight breakdown, support the channel by subscribing and comment Our John AG. That tells me you're here for the long game. So here's the situation. Silver ran like a machine that suddenly found another gear. It moved from the high double digits into the low triple digits. Then it slammed back down into the mid-70s. And that kind of move does something strange to people. If you bought early, you feel like a genius. If you bought near the top, you feel like the market personally attacked you. And if you never bought at all, you're sitting there hoping for one more drop, but secretly afraid the train leaves without you. Now the easy answer is, well, silver is in deficit, industrial demand is strong, China wants more of it, and therefore price has to rise a lot. Okay, that sounds clean, but markets usually punish clean stories. So let's take this apart piece by piece. First, did silver's big spike prove that the bull market is over? I don't think that's the right question. The better question is this: did the reason for owning silver disappear when the price corrected? And the answer, in my view, is no. Based on recently published numbers, silver is still expected to remain in a supply deficit this year. But here's the part people often leave out. Demand is not perfectly fixed. When prices jump too far, manufacturers look for ways to use less silver, especially in solar panels, electronics, and other high-volume applications. That's the counterpoint nobody wants to hear. Silver can be structurally tight and still correct hard. Both can be true. Think about it like this. If a factory manager believes silver might not be available next month, he doesn't just buy what he needs for tomorrow. He tries to build a cushion. That cushion buying can push prices higher very quickly. But if prices fall, supply starts showing up again, and the panic fades. That same buyer can step back. So what looked like a permanent shortage can turn into a temporary inventory scramble. That's why I don't love the phrase, silver has to rise. It probably needs higher prices over time to balance the market, but it doesn't owe anyone a straight line. Big difference. And this is where China matters, but not in the cartoon version people keep repeating. The clean version is not that China simply banned silver exports. The more accurate version is that exports are being handled through licensing and approved companies. That's a control system. That's not the same thing as locking the gates and throwing away the key. At the same time, recent market updates showed China importing record amounts of silver in March, helped by investment demand and the solar supply chain. So is China hoarding silver because they secretly know something? Maybe partly. But there is a simpler explanation too. China makes a lot of the things that consume silver: solar panels, electronics, industrial components. If you were the country sitting in the middle of that production chain, you don't want to wake up one morning and discover the raw material is floating away to the highest foreign bidder. That doesn't mean silver goes up tomorrow. It means silver is becoming more strategic. Now, gold is a little different. Gold is not really an industrial story. It is a confidence story. And lately, confidence has been getting tested from every direction. Government debt is larger. Interest costs are heavier. Oil prices have been jumpy because of the Iran situation and the Strait of Hormuz risk. Bond markets are more sensitive. And central banks are still showing interest in gold, even after prices moved sharply higher. According to the latest publicly available demand data, official gold buying remained strong in the first quarter, and investment demand stayed meaningful even while jewelry demand struggled under high prices. That tells us something important. At lower prices, people buy gold because it feels affordable. At higher prices, institutions buy gold because they want protection. Same metal, different motivation. But here again, let's not oversimplify. War does not automatically mean gold goes up the next morning. Sometimes investors run into the dollar first. Sometimes higher oil creates inflation fear, which keeps interest rates higher, which can pressure gold. So if you're buying gold only because you think conflict equals instant profit, that's too thin. The stronger case is not war. The stronger case is what governments do because of war: debt, spending, deficits, and central bank rescue operations. That's where the real story starts to get uncomfortable. Money supply has been rising again. Fiscal deficits are not exactly disappearing, and when bond markets get nervous, governments face a choice nobody likes to talk about: cut spending, raise taxes, or lean on the central bank and hope the market keeps believing the story. Historically, politicians do not enjoy choosing pain. They prefer delay. They prefer another program, another issuance, another explanation, another promise that growth will solve it later. And sometimes delay works for longer than skeptics expect. That's important. People have been calling for fiat collapse for decades, and yet the system keeps limping forward. So I would not sit here and tell you the whole thing ends next Tuesday. That's lazy. But I would say the cost of maintaining the system is going up. Look at what happened in the United Kingdom a few years ago. A bond market shock hit pension strategies that were supposed to be boring, and suddenly forced selling created a feedback loop. Prices fell, yields rose, collateral pressure increased, and the central bank had to step in. That was not some fringe coin shop story. That was the government bond market, the place everyone assumes is safe. And now investors are watching Japan, the United States, and Europe with a different kind of attention. Not panic every day, but attention. So what does that mean for physical gold and silver? It means the time to think about access is before everyone else thinks about access. During calm periods, price feels like the only issue. During stress, availability becomes the issue. Premiums widen, delivery gets slower, dealers get busy. The question changes from what is the quote to can I actually get it? And that is why physical metal is different from mining stocks. A coin in your hand is boring on purpose. It does not report earnings. It does not dilute you. It does not miss guidance. It does not need a permit. It just sits there. Mining stocks, on the other hand, can be incredible in a metals bull market, but they are still businesses, and businesses can make mistakes. So when people say miners will finally outperform, I say maybe, but don't buy the whole sector with your eyes closed. The first thing I want to know is simple. Is the company actually making money now? Not someday, not after the next financing, not after the perfect feasibility study, now. Because if a miner is burning cash, the shareholder is usually the backup plan. That means new shares, discounted deals, debt, asset sales, or some combination of all of it. And by the time the metal price finally does what you hoped, you might own a smaller piece of the upside than you thought. Then we get to costs. All-in sustaining cost matters because it tells you how much room a miner has between survival and stress. A low-cost producer will not be the most exciting name on the screen every single day, but it can live through ugly markets. A high-cost producer can fly when gold rises, because each extra dollar drops harder into the margin. But that same leverage cuts the other way. When gold falls, the exciting company can suddenly become the company asking shareholders for help. So yes, miners can give leverage, but leverage is not a gift. It is a blade. Now let's talk about entry, because this is where people usually sabotage themselves. They do all the research, watch the interviews, study the chart, convince themselves the thesis is perfect, and then they buy the whole position at once. And immediately, the stock drops. Not always, but enough times to make you question your entire personality. A better way is to split the position into pieces. Start with part of it. If it rises, good, your thesis may be working, and your existing stake is already helping you. If it falls, but the facts are still intact, you have room to add without panic. If it goes sideways, you have time to think. That's the hidden benefit. You are buying yourself emotional flexibility. Because the worst investment plan is the one that requires you to be perfectly right on the first day. And after you buy, give the thesis time to breathe. Not forever, not blindly, but enough time that you're not reacting to every headline like it's a verdict from the heavens. If the business case breaks, sell it. If the stock falls for reasons that have nothing to do with the business, maybe that is opportunity. If the stock becomes a big winner, don't be afraid to trim some and keep some. You don't have to marry every position, and you don't have to divorce every winner either. If you're successful, share your success story in the comments so others can stay motivated. People need to hear real examples from viewers who stayed patient, managed risk, and didn't let emotion run the whole account. Now, on oil, I want to be careful. The Iran situation and Hormuz risk have made energy markets extremely jumpy. Crude moved into the low hundreds recently, and the headlines can make people want to trade oil directly. But oil futures are not a video game. They are tied to physical delivery, storage, timing, and contract mechanics that can destroy people who think they are just betting on a line going up or down. We already saw, a few years back, that oil futures can break in ways retail traders never imagined. Storage filled up, delivery became a problem, and prices went below zero. That should be burned into every trader's brain. If you want energy exposure, there are cleaner ways to think about it, like strong companies with real assets, disciplined balance sheets, and less direct exposure to choke point chaos. But even then, you have to know what you own. So putting it all together, do I think previous highs in silver and gold can be surpassed? Yes, eventually. I think that is very realistic. But I don't think the path is going to reward people who need instant confirmation every morning. Silver may need time. Gold may shake out weak hands. Miners may move late. Oil may whip around on one headline. Bond markets may look calm. right before they are not. That's the environment we're in. And here's the part I keep coming back to. Precious metals are not just about getting rich. They are about staying solvent when the assumptions underneath the system start to wobble. That does not mean panic. It means preparation. It means position sizing. It means understanding the difference between physical metal, ETFs, miners, futures, and cash. They are not the same tool. Physical metal is insurance. Miners are speculation with business risk. Futures are professional instruments. Cash is optionality. And if you mix those up, the market will teach the lesson in the most expensive way possible. So don't let a big price drop convince you the story is dead. And don't let a big price spike convince you risk disappeared. The truth is in the middle. Silver's fundamentals still look tight. Gold's monetary role still looks important. Government debt is still a problem. Central banks are still part of the demand picture. But corrections are normal, substitution is real, and bad timing can make a good thesis feel terrible. That's why the smartest move is not to chase emotion. It's to build a plan. Buy slowly if you're accumulating, study cost if you're buying miners, respect liquidity if you're trading, keep enough cash so you don't become a forced seller, and never confuse a viral prediction with a risk-managed strategy. Because the market doesn't care how convinced you are. It only cares whether you survive long enough to be right. Because that first move against you is often the real test. Not the thesis, not the headline. The test is whether your plan was built before the emotion arrived or built after fear already had the steering wheel. And just to be clear, this is for education and market discussion only. I'm sharing how I think through the risks, the setup, and the moving pieces, but I'm not your financial advisor, and I'm not telling you what to buy or sell. Do your own research, know your own situation, and make decisions you can actually live with if the market moves against you first.